have gotten to. Sequoia decided this week and announced publicly that they're splitting off their China and India/Southeast Asia funds. As you guys obviously know, Sequoia Capital is a venture capital firm. And within that firm, they manage multiple funds. Some of the funds that they've raised and managed have been specifically targeted in China, where they have $56 billion. I don't know if this number is accurate, but that's an incredible number. $56 billion of assets under management focused just in Sequoia China. And then they have a Sequoia India fund, which has about $4 billion of capital raised in just the last 3 years. And now they are separating the management company and the oversight of those funds into separate management companies. So Sequoia Capital will no longer oversee those China funds. A new firm has been formed called Sequoia China that is now owned and run by a separate management team based in China. And Sequoia India is now called Peak 15 Partners, which is owned and operated by a separate team of managers out of India. Roelof Botha will manage the US and European Sequoia Capital. Neil Chen will oversee Sequoia China, and Neil Shen. And Shailendra Singh will oversee Sequoia India. I guess this is a question of, did Sequoia get too big, or are they caving to pressure of the political issues arising with having deep relationships and ties with China? Or, as they have said, a lot of competition between these different portfolios and companies within these portfolios amongst each other. Chamath, what's your read on the action? Is there anything to read into this and anything to extrapolate from it?
Well, it's been a parade of missteps for Sequoia in the last couple of years. And I'll let Sequoia figure out who to blame for this. But the reality is they, I think, felt a lot of FOMO post SoftBank. They raised this large mega fund that kind of straddled all of the sub funds and straddled all of the regions. And so they dangled the carrot of trying to get into the early stage US fund by investing in this big mega fund that also had China and India exposure and growth exposure. Then they tried this like very convoluted evergreen structure right before the market fell apart, where you could basically become a permanent capital vehicle. And as far as I can tell from the outside looking in, it just seems like a tax play for the GPs to not have to sell and realize capital gains. But that only works when the stock market keeps going up, which it didn't, and then it summarily crushed tech stocks 80 or 90%. So that was a misstep. And then when you put all these things together, now that China is contracting, and we've said this before, I think China is largely uninvestable for the next 30 or 40 years. It just makes sense to jettison it. Now, I will say, though, that Neil Shen is elite. If you consider in investing, I would say I have a simple rubric. Anybody who's made more than $1 billion for themselves as an investor, I consider elite. Neil Shen is elite. And so he'll do just fine running that Sequoia China business. I was surprised about why they would allow India to leave. There's nobody that elite at Sequoia India by that rubric. But India is a country growing at 6% a year. It literally looks like China in 2008 and 9. And so I'm not sure why you would let them leave. I think that you would want to attach them to yourself because it makes the US business look better. You probably get differentiated and smoothed out returns. But I think this is a little bit of
point of view of competition, Chamath, that there was competition between the different portfolio companies. And it was leading to conflict.
That's stupid. I mean, that's dumb. That happens in the United States. Sequoia has always been known to fund everybody that they think will make money, no matter how much they compete, no matter where they are.
It was controversial when they backed YouTube, and Moritz was sitting on the board at Google. And
sure, look, Sequoia as an organization is elite. They're there to make money for their LPs. Period. End of story. And so all of the other words that can go in any press release, basically, I think, try to hide the fact that this is an organization that's had some missteps. They're not on solid ground. They've lost a lot of money, and they're trying to figure out what to do next. I, however, if I was running that organization, would have probably done nothing and just let the dust settle. And I think that all of these actions are too close together, and it's a little bit, to me, of flailing in the water. And so I don't think it was a good idea to let India leave. I think it made a ton of sense to cut China. But I think all of this stuff started happening a few years ago, starting with that $8 or $9 billion mega fund that they raised to try to compete with SoftBank.
Sachs, any read on this?
Yeah, I mean, I think it's a prominent example of decoupling and globalization going on. So I agree we have to treat India and China separately. With respect to China, I just think it's become harder and harder for Americans to do business in China, both because we don't really have the visibility into that system and there's too much political uncertainty. So kind of to Chamath's point about it being increasingly uninvestable. But I also think the geopolitical concerns, it's just very hard to straddle those concerns now because the geopolitical competition is heating up so much. I think it's investable for people like Neil Shen, who are insiders in that system. So I think, elite Chinese investors can, I'm sure, make money in China over the next few decades. But I think it's just too hard for Americans to figure that out. So I think them parting ways makes a lot of sense. I think it's going to simplify Sequoia's life a lot. India, I agree with Chamath that that's sort of a different question because India is going to be a huge growth economy over the next few decades, and they are a U.S. ally. So it doesn't pose the same geopolitical risk. But my guess is that it was just kind of unwieldy, that it's too unwieldy to kind of merge funding sources and firm management across two firms that are really pretty different, right? The U.S. Sequoia firm and then this Indian firm. So my guess is they just decoupled because it was just getting too hard to manage. And if you're an LP, don't you just want the ability to say, okay, I'm going to allocate this much money to India and I'm going to allocate this much money to the US? I think LPs probably like it too.
Sequoia China is frankly, over the last 15 or 20 years, as good and probably is numerically better than Sequoia US. So that was an elite organization just by itself. Sequoia India, I don't think has much to talk about. And so maybe what Roloff decided is this team is just not very good, so we might as well just cut it and we can revisit it later. They probably have some number of years of a non-compete and then they could come back into the market 5 years with a totally new team and that may be easier. So it may be easier just to
maybe the team there they wanted to be separate. Look, it's hard to cross returns from two totally different funds, right? Because one side's going to be unhappy with the trade, right?
Yeah,
that's right.
I can give you the...
JCal's got actual information to share.
Yeah. Well, no, I mean, I have the closest. I think I have the closest.
But they were an investor in your company, right, JCal?
Well, I'm an LP in their funds. They're printing money for me. They backed my second startup. Roloff's on the board of that company, still with me. And I was their first scout when they started the Scouts program, which is the highest percentage performing fund I think they ever had. Sequoia's
and
20.
You're our resident Captain America. So as a patriot, how do you feel about
they are, put that aside. Sequoia is 20% of the NASDAQ. This is the greatest venture firm of all time, hands down. And the Sequoia Fund, which Chamath referred to.
You mean companies they've invested in?
Companies they've invested in are 20% of the NASDAQ,
right.
yes. And so the reason the Sequoia Fund came out, this evergreen fund, was because a lot of their LPs wanted Sequoia to manage the public equities going forward because they didn't want to sell them because they realized that the massive gains, the gains from Google, Apple, et cetera, of these investments that they did when they were private companies, Cisco, the gains from public forward were greater than the gains in private. And I've been in on these presentations. I've sat through them with the Sequoia team. And so when you manage those public ones, we've all talked about the denominator problem here. The denominator problem is, hey, are they venture returns or are they part of the public equities? So at a giant endowment, they want to put them into the equities bucket, get them out of the venture bucket. And Sequoia saw an opportunity there to manage this evergreen fund. I'm sure there are tax advantages to it, of course. But with relation to what they did in China and India, these were incredibly prescient and innovative things they did in 2000 and 2005 when they started India, and then China was 2005, I believe. They found domestic teams. You need domestic teams to do this properly, especially in places with different governance and different regulations. And it gives them autonomy. They were incredible investments. But what's happening right now is all venture investments, because of AI and chips and the decoupling with China, are now under massive scrutiny. So they can say there's brand confusion. You can talk about, the collisions and who's going to back this Chinese